in Canada, and we're going to learn about the details of how to maintain a very high credit score at all times. All right. All the advisors, make sure you take detailed notes so you can share with your clients and educate them about this. We're going to understand that debt is a big factor in our life if we want to build more wealth. And we're going to understand 3 important factors about it. But just before we start, we always start very basic and we build our way forward. So, ladies and gentlemen, as you understand, financial independence is the most important thing that you want to be aware of. So we've talked about this many times. Financial independence is a stage of our life that we will have enough wealth saved up that we be able to get the required cash flow that we want out of it in order to satisfy our lifestyle. So the reason we go to work is not just to survive. The reason we go to work is to build enough wealth over time so we can become financially independent. Let's move forward. We understand in all the sessions that we've done in our system that we educate many Canadians on a daily basis. We've said our life has 2 stages. The stage that we just talked about, the growth stage. This is when we're working and we get into the habit of building wealth. And we've talked about this. Building wealth has a simple formula. We need to learn and get into the habit of saving. We need to learn how to grow our money over long term so we can beat inflation. We need to learn to have tax strategies and be tax efficient with our money as we're building, growing, as well as earning that income. And we need to learn to protect against, God forbid, death, as well as critical illnesses, especially during the time that we're building that wealth to get to financial independence. At one point, and the age doesn't matter, it might be age 45, 55, 65, it's the stage that we have accumulated enough wealth that now that wealth can give us a tax efficient, what we call cash flow, which will satisfy our lifestyle needs and basically be able to feel you're financially independent at that stage because you built enough wealth that can satisfy your lifestyle now. So today we're going to discuss debts. We're going to understand loans. We're going to understand credit. I want you to write this down. Credit is a very important thing in your life. Debt, despite what the average have a mindset about it that it's a negative thing, it's one of the greatest things that allows you to build more wealth if you know how to use debt in the right way. So number 1 thing you need to understand about debt is that, write this down, don't ever borrow to spend. You always want to borrow to invest. So if you speak about any individual that is a multi-millionaire or a billionaire, they will tell you that one of the biggest source that they use to build wealth is good credit, is good debt. Because debt allows you to build more wealth, allows you to have access to more money while you haven't made it yet, if you have the cash flow to be able to make the interest payments and everything to it, and yet grow it at a higher rate of return in your investments, whether it's mutual fund or whether real estate. So number 1 thing, debt is good, not to borrow and travel with that money or buy a TV or just buy a car or these things. Debt is good to borrow and invest, such as number 1, mortgages. Mortgages are great and allows you to actually buy a bigger portion of a house. As long as you can weather the up and down in the market, you're always going to be good over time. You're going to have more rate of return compared to the interest that you pay on your debt. Number 2, leverage. What is leverage? It's the same idea as a mortgage. You borrow in a mortgage to invest in real estate. Leverage means borrow to invest in mutual funds. So myself and many of our clients, upon having good credit, having good debt, as we build some wealth, the level 2 of the strategies that we discussed with them is now maybe looking into borrowing to invest more. So you use that lump sum to grow your money over longer term. Number 2, good thing about debt, write this down. Debt is tax free. So one of the main things that very wealthy people understand and always use debt to build more wealth, or even debt over time as they build it to even purchase some stuff, is that they understand debt has a tax-free nature. So it's a great thing for us to be able to actually borrow more and invest more and build more wealth. Number 3, One of the greatest things we need to understand, based on Income Tax Act, any interest that you pay on any loan that you invest, that loan, that interest is tax deductible. Write this down. That interest becomes tax deductible. So another good thing about debts, for those who can build wealth over long term, not look at the up and down in the market in 1 year, if it's a bad year or if it's just a very good year, and based on that, average markets will always go up. Same with interest rates. Not look at if we have a very low interest or a very high interest at a time, it will always average itself out. Over time, borrowing to invest will allow you to build more rate of return compared to the interest that you're paying. Of course, if you have a good credit and you're getting good interest type of loans, right? Number two, debt is tax-free. Number three, even that person that is building the wealth, they can tax deduct the interest portion of that loan that is invested. So these are three great things that we need to be aware of about debt, and why credit is so important for you to build, and why debt is an important thing to build wealth. Let's move forward. So now that we understand about building wealth, about our growth stage, cash flow stage, as well as the benefits of debt, let's understand first the types of interest. So ladies and gentlemen, we've talked about this many times. We understand interest is either simple or is either compound. Just as an example, if someone has $100,000 and let's say they earn 10% simple, 10% compound. Simple means in the first year, 100 goes to 110,000. In the second year, they still get 10% on that initial money that they invested. So it will go to 120,000, 130,000. So simple interest means that money is only applied to basically the interest is applied to the initial capital invested. So after 10 years, you have $200,000. However, compound interest means that interest over interest. So you understand, compound interest is great to earn, but also compound interest is not so good if we're paying it on our debts. So you need to understand, compound interest means the first year, 100,000, we get 10%, goes to 110,000. The second year, we get 10% of the 110,000, so goes to 121,000. The next year, you get 10% of the 121,000. So I can tell you, in this case, after 7 years, you're already at 200,000, and then you have more to grow. So compound interest always grows faster compared to simple interest. So if I were to ask you as an individual or family in Canada, would you like to earn compound interest or simple interest? The answer is, Dave, I like to earn compound interest. Where do you get compound interest? In real estate investment, in mutual fund investment, in stocks, in bonds. Where do you get simple interest? Well, in a regular saving account at the bank, in a GIC, in regular stuff that you get very low interest type of instruments in the banks. So we want to get compound interest. Now, let's ask you, if you have debts, would you like to pay compound or would you like to pay simple? We like to pay simple interest if we can, not compound interest. All right, so now that we understand this, we're gonna make this even more bold. So now let's go into it. Ladies and gentlemen, even compound interest in Canada, compound interest has 4 different types. Compound interest could be daily. So that means that it is compounding on a daily basis. Compound interest could be monthly, so it's compounding on a monthly basis. Compound interest could be semi-annually, so every 6 months it is compounding, and it could be annually. So every year it is compounding. So if I were to ask you, your mutual funds, are they simple or compound interest? You're like compound interest. What type of compound interest? The answer is mutual funds are compounded on a daily basis. So that's an amazing thing. Remember, the more frequent compounding happens, the better it is if you're earning. And the more frequent, if you're paying, it's good for that person earning it. It is not so good for you paying it. So now that we understand the types of compounding interest, let's go and understand the different debts that we have. So, ladies and gentlemen, the first type of debt that we like to talk about, credit cards. Probably the worst also type of debt, but it is important for us to have at least 1 or 2 lines of credit cards and use them. And hopefully at the best time, we can always pay them off, or we're going to understand about utilization, about credit cards and these type of loans. So credit cards are the type of loans that we call revolving. So guess what? Credit cards, in fact, are daily compounded. What is the average rate of a credit card? 19.9%, 21.9%. Imagine how high that interest is. Understand that it is compound as well as it is actually daily compounded interest. So credit cards are not such good debts. However, we can use throughout our life, and then as long as by the statement dates, we can pay them off. It is a great, great way to use these credit cards because you're using a free type of debt to pay for the expenses. Then you pay it at the end of the month, whether you receive your business income or your employment income, and then you don't accumulate any interest. So mortgages, when it comes to mortgages, we have different types. For example, we have actually like fixed type of mortgages that generally fixed mortgages are semi-annually compound, right? But we have variable mortgages that are monthly compound. Again, I don't want you to just look at that and make a decision, oh, because of that, because less compounding is better when I'm paying debt. So this is the best, this is the worst if I'm paying debt, right? Then I should go with fixed mortgages all the time. No, not necessarily. It is important to your risk tolerance as well as understanding where the markets are, where the interest rates are and everything. So sometimes variable mortgages are great, sometimes maybe fixed mortgages. So you have to consult with a mortgage advisor as well about all of this. So a line of credit, actually, we have 2 types of line of credit, secured and unsecured. What does that mean? Secured line of credit means there's a collateral or a security behind it. So like a line of credit on homes, it is called home equity line of credit. So when there is a type of a collateral or a security behind it, you should understand the risk of the lender is also lower. So therefore, there's going to be lower amount of interest you have to pay. So secured line of credit has a lower interest, and unsecured line of credit means there's no collateral, there's no security, have higher interest type of basically payment attached to it. So you need to understand, and that's why you don't get big portions of unsecured line of credits, 50,000, 100,000. You don't get $1 million of unsecured line of credit unless maybe you've built a phenomenal business and you have a lot of assets and everything. But in general, unsecured line of credits are smaller because they have no security, and therefore the interest rates are higher because they have more risk. I want you to know, line of credits are actually simple interest. They are great. They calculate interest on a daily basis. Whatever your portion is, that's the interest that gets calculated on that day. Does that make sense? So that's also a good thing. Leverage is also simple interest. So that's a good thing. And we understand mutual funds, well, that's not a debt. That's an investment that you understand you earn daily compound interest. So let's review. Do I want to earn simple or compound interest? I want to earn compound interest. Which compounding is the best for me if I'm earning it? The more frequent. So that means daily if I'm earning it, which is mutual funds. If I want to pay, what type of interest do I like to pay? First, if I can, simple interest. So lines of credits are great type of debts. But at the same time, if I'm paying my debt, I like to pay the least compounding type of interest. So that means around this area. So credit cards are daily, variable mortgages are monthly, and fixed mortgages are semi-annual. Hope that made sense. All right. Now that we understand this, we're going to move forward to credits and understanding the credit system in Canada and how to improve the credit rating using this system. We're going to learn about the organizations that provide your credit system as well. Let's move forward. Ladies and gentlemen, there are two main agencies in Canada that will be having your credit reportings done. All the lenders will report to these two credit agencies on a monthly basis. Generally, either around the last 3 to 5 days of the month, between the 28th of the month to 3rd of the month, either the report, or they report on your statement date. So if your credit card is, let's say, on the 21st of each month, that's the statement date. That's when they're going to be reporting the balance every time during that time. And also they report if there's a late payment, if there's anything. We're going to go through that. So you got to understand, TransUnion and Equifax are the two main credit agencies in Canada. So let's understand, first of all, what is a credit score? A credit score, ladies and gentlemen, is a number that companies use to try to predict how likely it is that you will pay your bills on time. It is an estimate of how reliable you are as a debtor. So you need to understand, credit score is important, but credit score is not the only thing that is important. That's what you have to understand. Lenders don't just, they look at the credit score as a big criteria, but that's not just the only thing they look at. We're going to go through some of the stuff. The higher your credit score, the better, and the high credit scores tell lenders that you are extremely good about paying your bills on time and are a safe investment for lending money to. So that's why they look at that credit score. Meanwhile, low credit scores tell lenders that you're a high risk proposition, so they'll be less likely to want to work with you, or if they do, they will give you higher interest type of debts to offset their risk, because you're not a very reliable high credit score type of a borrower. If you want to know your current credit score, you can check it through credit bureaus such as Equifax or TransUnion. I do suggest that after this session, especially all the advisors, you need to be the role model for all the clients that you're educating. Make sure you go on the Equifax website or TransUnion, you subscribe, and you can do a monthly pay, or you can do a one-time. Get your credit score. I do advise everyone to do it at least every 6 months or so, right? Get your credit score and look at your credit report in detail. I don't like it that these the credit reports and stuff are given to you maybe through your banks or through some of these websites, because they're not giving you the details and complete package that you should be looking at. So you want to do it either from TransUnion or Equifax, which is going to show you the absolute details that you need to understand. All right, let's move forward. Ladies and gentlemen, what is a good credit score and what does it range in? The credit score ranges between 300 to 900. I want you to know the banks look at 680 and above. So if you want to build a good credit score, you should be above 750, and that becomes kind of in the very good, in the excellent credit score. And above 800 will be actually excellent credit score. So you could use that, and you see a score above 760 is considered excellent by Equifax. So it is important to build that higher credit score. Now, before we get into that, to build that credit score, I want you to understand, a credit score is not something that is given to you and stays. It can change on a monthly basis. So it is important to adapt good habits and good things that you do to build that credit score over time and maintain that good credit score. The longer you have a good credit score, the easier it is to maintain it. So we're going to go through all of that. Why does good credit matter? Well, we talked about it. Debt is important. We want to get approved for any kind of loans or mortgages, borrow to invest, maybe renting an apartment. You need to have a good credit. They check your credit, especially nowadays, right? Maybe getting new credit cards or line of credits. It is important for you to have good credit so you can actually use that not only to build more wealth, but run a lot of different things. If you want to run a business, you want business loans and everything, you need to have a good credit. You want to buy a house, you need to have a good credit. You want to rent a house, you want to have a good credit. So these are important things to have. All right. Ladies and gentlemen, this is the way kind of the new credit system look on Equifax. If you log in and you see it, that they've changed some stuff about it. Now, what is very important that we're going to talk about, this is one of the clients, and we're going to look at some of the numbers and understand why. So you can see it goes from 300 to 900. One of the biggest and the most important thing based on the new credit system that this basically computer software does is this. Write it down and we'll talk about it. Credit utilization. How many percent of your credit is actually utilized? So as good as you can be with your credit, you can see when you are this high in your credit utilization, your score doesn't kind of start going above that 750, 760 level, right? It stays that level because it needs to breathe. It needs to show. The more credit you use, the more you're showing to other lenders that you have a big need of money and debts. So this credit utilization is the biggest focus of the new Canadian credit system now. And we're going to talk about this. All right. We're going to understand what will move our credit from 300 to 900 or back and forth. We're going to understand different factors one by one and how many percent each of these factors can impact your credit. All right. Before we go there, in the new system, your accounts are actually separated based on this. So the number one group is called revolving credit. So if you go on Equifax this evening and you actually go, let's say, get your credit score and credit report, you'll see the same things. You see how your accounts are categorized based on this. The first category is revolving. What does that mean? Revolving is the type of debt that you can pay off all the time, you can use again, you can take you can take as much and you can pay as much off, and then you can pay just the interest and just basically maintain it. So basically, revolving type of credits are the debts that could be just interest only payments. We can pay as much of it we want off, or we can use as much of it based on our balance out again, such as credit cards. Credit cards are in fact revolving accounts. Line of credit, another one, right? Loans that are just interest only payment or open to be paid at any time. So credit cards and line of credits are debts that you could use. It's revolving. You could use as much and pay off and then use again. We're gonna understand. This is the biggest portion of your credit that the utilization matter to. Do you understand? So that's where the utilization is calculated in the revolving one. So write this down. The next accounts are mortgages. Will everyone understand those? If you have any mortgages. Are mortgages revolving? No. If you have $500,000 a mortgage, what are you paying? Interest plus principal. So it's a loan. It's an installment type of a loan. So you're going to be paying it off. So is this. That is called installment. These are loans that have interest plus principal. Unlike the revolving type of debt that you can just pay the interest payment, like the credit card, like the line of credit. So examples of installment loans could be your student loan, could be your car loan, could be your leverage loan, or your mutual fund investment loan. So these are the examples of installments. And you can always see you have others. You need to watch for this. The other one is generally your phone companies, whether it's Rogers, whether it's Fido, whether it's TELUS, right? Any of these, that's where they get reported. So remember, your utility bill, your hydro bill, these things don't get reported. But for some reason, your cell phone bill gets reported to the credit agency. So you have to be up to date with your cell phone bills. You have to pay them because that could actually ruin your credit, unfortunately. All right. Now that we understand the type of accounts, let's go and understand what are the components that will impact our credit score and how many percent. We're going to go through 1, 2, 3, 4, 5 different things. These 5 things impact your credit score, and we'll see by how many points Could it go up or could it go down? Let's look at it. The number one, most apparent thing that most people, it's the only thing that they focus on, and they think that's why the credit, that's the only thing about credit, right? And it's not. There's many other things that will bring your credit down. The number one thing is payment history. Are you making your payments on time? So let's take a look at this. When it comes to payment history, so we're looking at a credit card. Let's say I have a $20,000 limit on my credit card. I use this month, let's say $15,000 of it is used. My statement comes on the 20th of the month and says you have $15,000 and your minimum payment is, let's say, around $500. Generally, if you look at this, you're like, Dave, $500 for $15,000 is quite a high interest payment. It's more than the 19.1%. Yes, the minimum payment on the credit cards is generally around 3% of the balance of that month that they want from you. So they want to see you can actually service that debt a little bit more than just the interest, right? But it's still a revolving type of debt. So it says, hey, 20th of, let's say, just as an example, 20th of June, it's due. Well, I have the ability that to pay the full balance by 20th of June, right? If I pay that, no interest is charged by the due date. So if you have due dates on your statement, you pay it off, you don't have any interest. So it's good, perfect. Now, if within 30 days, let's say this is a TD bank, by the way, if within 30 days, I haven't made at least the minimum payment, now I'm already, so after 20th of June, which was my due date, if 30 days after, this is, let's say 20th of June, within 30 days, I still haven't made my payment. Now I have a late payment type of a category. Now I have a late payment status. What happens? That doesn't get reported to the credit. I'm giving you a little bit more details. That still gets a bad rating in TD. TD has, all the banks have internal ratings themselves. Within the 31st day, if it goes to 31 days, now the 30 days passed, now it gets reported to Equifax and TransUnion as now late payment. You get a late 30-day payment. You don't pay it for another 30 days, you get another late 60-day payment. You don't pay it for another 60 days, now 90 days. Of course, your credit has been ruined now. After that 90-day, so you can see late payment, first internal rating, then you have 30-day late, 60 days, 90 days. So from the due date, for 30 days you don't pay it, the internal rating of the bank kind of gets ruined. And then after that, it gets reported if it's 30-day pass, 60-day pass, or 90-day. After that, it goes to collection. And the bank doesn't deal with you anymore. The collection will come on your credit report and actually just demolishes your credit score. So one of the things that you want to stay away is collections, is when you don't pay a debt and it goes to these collection agencies where they're going to collect on that date, on that debt. And what happens? That ruins your credit. So write this down. Now, many people have serviced their debts in the right way. Yet they come to me and I sit with them and I see that their credit is not good. And we see that there are collections that they weren't aware of. And the most common collection that you need to be aware of are parking tickets. Number one, if you have a parking ticket from City of Vancouver or City of Toronto, or I don't know, Alberta, City of Calgary or whatever, it goes to actually, after a while, if you don't pay it, it goes to collection and it ruins your credit. Another thing is generally dispute with phone companies and cable companies. So you have a dispute, Rogers says you have to pay an extra $300. You don't pay it, you don't pay it, you don't pay it. It's unfortunate, but they will ruin your credit. They will report it and you have a hell of a road to be able to get that fixed again. So you want to maybe pay it and then maybe, I don't know, just change the company if you're not happy with, and maybe dispute it afterwards, right? Cable companies the same. Unpaid taxes to CRA, that goes to collection. Over time, they will send you letters. They will say now it's going to collection. If you don't pay it, it could go to collection and it could show on your credit report. It could also become a lien on your property. So if you own a home, they put a lien on the property that anytime you want to refinance or sell, first they get paid out, right? And of course, some of the unpaid debts, like you didn't pay your credit card, you didn't pay your line of credit, you went late payment, late payment, late payment, and then it became collections. So those really are important in the payment history. Of course, if people have a lot of debts and unfortunately they can no longer service, the way to do it is not to just continue going with this. At one point, you want to cut the cord, you want to reset and start again. And that would be either bankruptcy or a step before bankruptcy is called consumer proposal. So I'll explain quickly about this. We all understand bankruptcy. You basically said that, hey, I no longer can pay my debts. Your credit kind of gets frozen for 5 to 7 years. But the debt becomes zero, you declare bankruptcy, and then you get discharged and you basically reset. The bad thing about bankruptcy is that a lot of different applications, whether you're applying for a job, whether you're applying for a life insurance, whether you're applying maybe to rent a home, whether you apply for many other things, they ask, have you ever had a bankruptcy before? So a lot of people, to stay away from that, step before that, which we help a lot of our clients to be able to get rid of this debt once and for all through companies like 4 pillars that we work with. It's called consumer proposal. So the person has, let's say, $50,000 of debt and has to pay around $2,000 a month of interest. What they do, the consumer proposal, the company comes and they negotiate with all the companies and say, hey, this is our step before bankruptcy. Instead of $50,000, we'll pay $15,000. And from now, we'll make $1,000 a month payment, but no interest is all to be paid. And by the time, maybe 2 years, 3 years that the loan is paid off, their credit starts getting recovered again. So just so you understand, these two do freeze your credit for an extended period of time, but it's also an easier way, a better way, instead of just being in debt forever, for many people to just reset once. The good thing about the North American system is that because of debt, you're not threatened to have your lifestyle change or anything. So you can actually just go through that, then do credit recovery, and then get better. Awesome. All right. So now that we understand about payment history, look at this. What we think is the only thing that matters to credit is actually 35% weight. But it could move your credit by 315 points up and down. So you might be at 750 and then a couple of late payments and it ruins your credit. Over time, it brings you down to 500 credit score. So that's very important to know. Now that we understand payment history, ladies and gentlemen, let's move to the important one, credit utilization. So if we're going to talk about credit utilization, we're talking, first of all, write this down, about revolving accounts. So credit utilization is actually about the revolving accounts. And it's a simple matter. It's a simple thing. It says if your limit on your debt is $10,000, basically, if you want positive rating on a monthly basis, do not go more than 60% of your limit. So if I have a $10,000 credit card, in my mind, I'm only going to use up to $6,000. And that's where I will get positive credit reporting. That's my maximum limit. That's what credit utilization is. How many percent of your limit are you utilizing, are you using? So 60% to 75% will actually be neutral if using. Above 75%, you start getting negative. So you can make all your payments on time, no late payments, but you're always on your credit card and line of credits are above 75%. Credit utilization, above 75% of your limit, your credit over time is getting negative and negative and negative, and it's just going decreasing over time. It's going down. And I want you to know, credit utilization, 99% and above will give you a very bad score. What do I mean 99% or 100%? Or even some people, unfortunately, at times go above 100%. So you have a $10,000 credit card and you use $10,000. Or sometimes you make some purchases, it becomes $10,500. That balance gets reported to the credit agency. You have a drop around 50 points like this. So it's important. So credit utilization is very important, but understand it is in the revolving accounts. You cannot go to a mortgage. You have $1 million mortgage and you're like, oh my God, I owe $1 million. Of course you do. That's an installment loan. That's a mortgage. So utilization doesn't matter in your car loan, doesn't matter in your mortgage. It matters in your line of credits, in your credit cards that are revolving, that you have the ability to pay them off and bring them down, or you have the ability not to use that much of it. So I hope you understood that. Let's look at this. The utilization of credit will move up to 270 points. It's a huge impact. It is 30% of your credit. So please pay attention to that. That builds your credit up. Next one, the credit history. The longer you have an account like a credit card or line of credit, the better it is for your credit. And if you keep up that good behavior, your credit up to 135 points can go up and down by doing the right thing. So what does that mean? Ladies and gentlemen, every time you get these updates, oh, we have a new credit card now. Oh, we have new bonuses. We get more points, less annual fee, all of this. And you go and apply for a new credit card, new account, every time your credit gets hit by that. So you can keep a credit card the same way and not get into that game, right, for an extended period of time, for 5 years, 10 years, 15 years, and use that same credit card. Stay within 60% of its limit. Your credit will be solid going forward. Every time you apply for new credit lines and credit cards and accounts, and a new account gets added to your credit, that's a negative score for you. So I hope you understand. Also, the age of your credit matters. So of course, someone that just landed in Canada and is building credit after 1 year, they're not going to have a very high credit score, right? Compared to someone who's been here 10 years, 15 years. So what do you mean? What do we mean by age? Number one, keep the same cards and accounts for a long time. That is good. Avoid applying for new lines and new credits unless you really need them. Don't get into that game of it, oh, new bonus or less annual fee or more points or things like that. Less of those, right? And also, the longer you build credit, the better and the more positive it is. It moves your credit by 135 points. All right, let's go to the next one that we'd like to talk about. Ladies and gentlemen, the next type of basically factor that will impact your credit is the type of credit. So in this case, I like to talk a little bit about this. So what do we mean by type of credit? So I want you to know, even the type of credit that you hold in your credit report, on your credit report, is actually very important, and it could score positive or negative. So here's what I would categorize as it. We have good debt and bad debt. Okay? Again, we go back to the first thing that we talked about. Good debt, just imagine it, it's borrow to invest and build. Bad debt, it's borrow to spend. So, what are some of the bad debt credit that we could talk about? Simply, number one, credit cards. Credit cards, that's why they're higher interest. So you see, bad debt is really high interest. Am I saying do not have any credit card? No, that's also not good. One or two, and that's as much as you need. If you need more credit limit, increase the limit. Someone might ask right now, hey, Dave, you said don't apply for new credit cards. yes. New credit cards, new accounts score negative. But if you have a $10,000 credit card and you'd like to increase the limit to 20,000 on the same credit card, that's not a new account. You can do that. You can increase it to 50,000, but keep that same card, use that same one, stay within 60% of the limit. So credit cards, what else is borrowing to kind of spend? Car loans, not good debt. They are bad type of debt. But of course, one is important. You have a car loan or you have a car lease, that's fine. You have one or two, don't get many. The worst debt that you can have, and I would hope you stay away, are actually these type of company debts that we call them, here it is, we call them finance companies and deferred payment options. Scores low. So what do we mean by that? For example, you go to Best Buy and you get a Best Buy card. All right, for 6 months, don't pay. Then after 6 months, if you don't pay it off, we're going to charge you 29.9%. Go look at it, right? And we're going to start it from the beginning, 29.9%, right? So you get that Best Buy card. You go buy furniture at the Brick, the same type of thing. So these type of basically cards that are deferred payment options and finance companies that they're not reputable lenders like banks. And look at the interest. The interest rate is generally 29.9%. Even if you have them, the existence of them on your credit report will score negative. You want to take them off. You want to remove them. If you like to buy a TV from Best Buy, buy it with your credit card and in a month pay it off or start paying it off over time. It's better than getting those type of cards. So these are what we call bad debts. Good debts, borrow to invest. So have as many mortgages. That's good, because every time someone looks at a mortgage on a credit report, they understand there's an asset called the house backing it up. So that's important. They have asset and now they have a debt on that asset. Leverage, same thing. They look at it and they're like, oh, they have $100,000 leverage. Well, they should have cash mutual funds in there. That's how they got to leverage. RRSP loans, TFSA loans, same kind of things. That's kind of also a leverage, right? Or even student loans are actually okay. They're good debt because you got that debt to actually go and build something for your life, right? You studied so you can build a business or go and have a better profession. So these, if you look at them, are lower interest rate as well. If you look at on this side, these are higher interest rate. Why? Good debt versus bad debt. The more of these you have, scores positive. The less of these you have, scores positive. Stay away from deferred options and finance companies such as Best Buy, Brick, all of these different things. So finance companies and deferred options, they score low. We need to be aware of them. Look, just by having the different type of credit can actually score 90 points up or down. So over time. So I hope you're aware of that. So what have we looked at, ladies and gentlemen? Payment history. Be on time with your payments. Make sure, if you can, by the due date, you're paying everything off so you don't even pay any compound interest on those credit cards. Credit utilization, huge, very important. Don't spend more than 60% of your limits. Stay within that. Watch your credit in the next 6 months, in the next year. It will shoot up because of these things. History of the credit. Avoid applying for many credit lines and accounts every time, right? If you're buying houses, mortgages are fine, but avoid getting new credit cards. Avoid getting into these type of games of, this annual bonus or you get points or this and that. Stay within the same credit cards you have. If you need, increase the limits. By the way, if this is important, I want you to know when it comes to building credit, there are many spouses, many couples that I've met that they come here and the husband has built credit and the wife unfortunately has not built any credit, yet they claim that, oh, look, she has a credit card too. She is maybe a secondary card holder. So there's no credit cards that are joint. If the husband has a credit card and the wife has a secondary card in her hand, that doesn't build her credit. Everyone should have their own lines of accounts, whether it's credit card or line of credit. And it is important, despite credit card, line of credit not being the best debt, right? It is important for you to have at least 1 or 2 lines of credits cards or line of credit as well to build credit up, because that's how you show that you're a responsible borrower, right? So I wanted to mention that. Last thing, sorry, the next one, credit type. So we talked about good debt versus bad debt, have mortgages, have leverages, have student loans. Those are fine, right? But not many car loans, not many credit cards. No, not any of those finance company and deferred option methods. So deferred option cards like Brick, like Best Buy, all of these different things. Stay away from those. The final thing, ladies and gentlemen, that again can move your credit by 90 points up and down, it is called inquiries. And what does that mean? It is simply how many times your credit has been checked. Credit checks are very important, right? So if we see someone that their credit has been checked 15 times in 1 year, well, that of course has lost nearly 90 points of their credit. Why? Because of course they need debt. They've been searching, they've been going around to get credit. Every time your credit gets checked, somewhere between 5 to 7 points is deducted. Every time your credit gets checked. Again, don't be aggressive with these things that I'm telling you. No, I'm not gonna have my credit checked ever again, or not even once in a year. 3, 4 per year, 5 per year is fine. You want to rent an apartment, you want to get a business loan, you want to get a mortgage, you want to get anything, it's fine. Too many will never be good. It will actually just give you negative scores. But also understand, you have soft inquiries and hard inquiries. So the hard inquiries are credit checks that loses points. When you go on your Equifax, you have an option to go into your inquiries and see exactly how many companies and who has checked your credit. There will be some that are soft inquiries. So these are just annual or semi-annually checks from the same lenders that you borrowed money from, and they just want to make sure that you're still holding a decent credit. So you see on the right side of it, it says, did it impact your credit? It says no, 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 no. So these are soft inquiries. And then there are ones that it says yes, okay? Those are the ones that are credit checks. So you went and you wanted to borrow something. So make sure you don't have more than 3 to 5 maybe per year. That also builds a positive one for you. Wonderful. So I hope you understood all of this. So payment history, utilization, how many % of your limit, history of credit, keeping the same credit cards and line of credits, not keep applying for new ones, the type of credits that we hold, and not frequently inquiries to have. So don't have your credit checked a lot. Let's finish with some of these things. Couple of things to actually just go over. How can I improve my credit rating? Number one, keep paying down your debt, especially your credit card balances, bills, and everything. That's a given. Try to keep your credit card balances below 60% of your available credit. You know about that. We talked about it. Avoid applying for credit unless you really need it. So we talked about it. Keep that history of your credit. Keep that age. Don't keep applying for new ones just thinking that, hey, I should have different ones. Have fewer credit cards over a longer period of time. We talked about the age of accounts. Immediately inform creditors and utilities and service companies of any address changes for your safety to go and avoid any fraudulent activities. Make sure your monthly account statements are correct. Read the statements and the literature you receive from your credit card company carefully and keep up to date. Deal with companies you know and trust. Get a copy of your credit report with 2 credit reporting agencies at least once a year and make sure the information is accurate. So that's important. Have at least 2 trade lines, credit cards or line of credit. So don't get me wrong, credit cards and line of credit. Credit cards are not the best type of debt, but they're important for you to build your credit. By not having any credit card, you actually don't build a good credit because you're not showing that you're a responsible person, but you don't need a lot. for at least 2 years with a minimum of $2,000 limit. Have credit cards in your name, as I just said. Don't be a secondary card holder. All right, next one. We all know, avoid bankruptcy. Avoid having many credit cards, just their existence will score negative. Avoid applying for many credit cards, loans, mortgages in different banks, especially in a short period of time. It ruins your credit. Inquiries will score negative, and having new accounts coming in will also score negative. Don't use more than 60% of your credit limit. We talked about it. Don't pay off your debts late. Don't accept or use any form of credit unless you fully understand it. And don't wait to report any unauthorized transactions. So one last thing I say, credit cards are insured. So if you lose your credit card or it is stolen and it is used $5,000, $10,000, it is fine. You don't need to freak out. You contact the bank or the credit card company and you let them know. They open an investigation. From that day, all those transactions that were done will be reversed and will be given back to you, because credit cards have an insurance inside of them already for these times. But your checking account or your saving account doesn't. So stay away from these scam phone calls, from these scam text messages, even a couple of emails, right? If you receive any of these things, remember, if the phone companies, if the bill companies, if the utility companies, if CRA wants to ever contact you, they will send you written mail. So even if they call you and you're unsure, they're like, send me mail. Do not answer them. Oh, you owe $2,000 to CRA, or we have to come collect it now. You have to go pay it. These are scam companies. Or you get a text message that you have a $200 refund from Fido or Rogers. These are scams. Do not do that. Do not allow, do not just, if you get a message from the bank saying, oh, your account has been compromised, log in now and change your password. That's a platform that they've built to get your password and be able to log in and empty your account. Do not do those. If there's any issues, you will get mail. And that's the formal way of communication with you. Wonderful. I hope you enjoyed today's sessions, ladies and gentlemen. I hope you took a lot of notes, and this can help you build credit. Remember, credit is very important. Number one, credit allows us to borrow and invest and build wealth. Number two, credit is tax-free. Number three, if we borrow and invest, the interest on that credit is tax deductible, which is an incredible feature into having credit used to be building more wealth. Thank you so much for joining us. I hope you enjoyed this session, and I hope you'll be able to share this with a lot of other Canadians so they can have a better credit as well. Have a great weekend, everybody, and we'll see you on the next Financial University session. Take care. Bye-bye.